For the first time in over 70 years, something unprecedented is happening in the world of finance. Global capital, the very lifeblood of the modern economy, is starting to flow out of the United States. Now, I know what you might be thinking. Oh, it's just another market correction, or this is just temporary volatility. But what if I told you this isn't just a blip on the radar? What if this is the start of a fundamental, structural shift in the global financial order? A long-term realignment of economic power that could redefine the next several decades. Today, we're going deep into why this is happening, what it means for you, and what the future of money might look like. This isn't just about numbers on a screen. It's about the very foundation of the world economy as we know it. So stick around, because we're about to unpack one of the biggest stories of our time. Let's start by understanding the magnitude of what we're witnessing. For generations, the United States has been the ultimate destination for global capital. It was the safest harbor in any economic storm. When there was trouble anywhere else in the world, a crisis in Asia, instability in Europe, or uncertainty in emerging markets, money would flood into U.S. assets. U.S. Treasury bonds, American stocks, real estate in New York and California, these were considered the gold standard of safety and stability. This constant inflow of money fueled American growth, kept borrowing costs low, and solidified its position as the world's undisputed economic superpower. This system worked like clockwork for more than half a century. But now, the gears are starting to grind. For the first time, we're seeing a sustained net outflow of capital. This isn't a one-month fluke or a quarterly anomaly. This is a pattern that has been forming and strengthening, signaling that the world's biggest investors' pension funds, sovereign wealth funds, and central banks are rethinking their long-held strategies. They're not just taking a little profit off the table. They are actively and systematically moving their money elsewhere. This is a tectonic shift. And to understand why it's happening, we need to look beyond the daily market noise and examine the deeper cracks that have appeared in the foundation. So, what's driving this historic change? The core reason is a massive erosion of confidence. The idea of America as the absolute safe haven is losing its shine. Why? Let's break it down into a few key factors. First, let's talk about debt. The U.S. national debt has skyrocketed to levels that were once unimaginable, now sitting at over $34 trillion and climbing fast. Every second it grows by tens of thousands of dollars. To finance this debt, the government has to issue more and more bonds. At the same time, the Federal Reserve has jacked up interest rates to fight inflation, making the cost of servicing that debt incredibly expensive. It creates a vicious cycle. More debt leads to higher interest payments, which in turn leads to even more debt. Global investors are looking at this mountain of debt and asking a very simple question. Is this sustainable? Can the U.S. truly afford to pay back what it owes without either defaulting or, more likely, printing so much money that it devalues the currency? That uncertainty alone is a huge red flag. Then there's the issue of political instability. The world watches the political polarization and gridlock in Washington and sees a level of dysfunction that is worrying. The constant fights over the debt ceiling, the threat of government shutdowns, and the deep partisan divides create an environment of unpredictability. Capital loves stability. It craves predictability. When investors be sure what the country's economic policies will be from one administration to the next, they get nervous. They start to hedge their bets. This political turmoil chips away at the trust that has been the bedrock of America's financial dominance. It's no longer seen as the steady, reliable leader of the global economy. Instead, it's increasingly viewed as a source of potential shocks and instability. When you combine this political risk with the enormous and growing debt burden, the perception of U.S. assets begins to change. They're no longer the risk-free investment they once were. They now come with a risk premium, and for a growing number of global investors, that premium is getting too high to ignore. This brings us to the second major force reshaping the financial world, the changing role of the U.S. dollar. For decades, the dollar has been the world's undisputed reserve currency. It was the no alternative option. More than 80% of global trade was conducted in dollars, and central banks around the world held the majority of their foreign reserves in dollars. This gave the United States what former French President Valéry Giscard d'Estaing called an exorbitant privilege. It could print money to pay its bills, and the rest of the world would absorb it. But that era of no alternative is coming to an end. We are now firmly in a multipolar currency world. The trend of de-dollarization is accelerating, and it's not just talk anymore. Countries are actively taking steps to reduce their reliance on the dollar. Look at the BRICS nations: Brazil, Russia, India, China, and South Africa. A group that has now expanded to include major energy producers like Saudi Arabia and the UAE. They are actively creating mechanisms to trade with each other using their own local currencies. China has been pioneering the use of its digital yuan for cross-border transactions, completely bypassing the dollar-based SWIFT system. When Saudi Arabia starts discussing the possibility of selling oil for currencies other than the dollar, that is a monumental shift. Oil has been priced in dollars for 50 years. This is the very definition of the petrodollar system that has propped up the dollar's global dominance. Central banks from China to Brazil are also diversifying their reserves. They're selling U.S. Treasury bonds and buying gold at a record pace. Gold is neutral. It's not controlled by any single country, and it has been a store of value for thousands of years. This rush to gold is a clear vote of no confidence in the future purchasing power of the dollar. The weaponization of the dollar through sanctions has also backfired. When the U.S. and its allies froze Russia's foreign reserves, it sent a chilling message to the rest of the world. If you are not aligned with U.S. foreign policy, your dollar assets are not safe. This single act has done more to accelerate de-dollarization than anything else in recent history. Countries are realizing that holding all their wealth in a currency controlled by another nation gives that nation incredible leverage over them. The logical response? Diversify. So where is all this capital going? It's not flowing to just one place. It's spreading out. We're seeing increased investment in emerging markets that are showing strong growth potential, like India, Vietnam, and Indonesia. These are countries with young populations, growing middle classes, and a focus on manufacturing and technology. Capital is also flowing into tangible assets like gold and other commodities, which are seen as a hedge against inflation and currency devaluation. We're also seeing a rise in regional financial hubs. Places like Singapore and Dubai are positioning themselves as neutral bridges between East and West, attracting wealth with their stability, business-friendly policies, and strategic locations. Even within developed markets, investors are looking for alternatives. They're increasing their allocations to the euro, the Japanese yen, and the Swiss franc, trying to build more resilient and diversified portfolios that are less exposed to the fate of the U.S. economy. This isn't to say the U.S. economy is going to collapse tomorrow, or that the dollar will become worthless overnight. The United States still has the world's most dynamic economy, the deepest capital markets, and a powerful innovation engine in Silicon Valley. The dollar will remain a major global currency for the foreseeable future. However, the period of its absolute, unquestioned dominance is over. We are moving from a unipolar financial world, centered entirely on the U.S., to a multipolar one with several centers of gravity. This transition will be messy. It will create volatility and uncertainty, but it also creates opportunity. For investors, it means looking beyond traditional U.S.-centric portfolios and exploring global opportunities. For nations, it means building more resilient economies that are not overly dependent on any single country or currency. The new financial order is being born, and it will be defined not by dominance, but by diversification and a rebalancing of global economic power. What we are seeing is not the end of America, but the end of an era of American exceptionalism in finance. The world is getting more complex, and the flow of global capital is simply reflecting that new reality. So, if capital is leaving the U.S., where is it all going? This is the billion-dollar question, literally, and the answer reveals the blueprint of our new financial world. A significant portion of this capital is flowing east, into Asia. Countries like China, India, and various Southeast Asian nations are becoming new centers of gravity for investment. Their growing middle classes, technological innovation, and expanding economies offer opportunities that are increasingly hard to ignore. We're seeing massive investments in infrastructure, technology, and consumer markets across the continent. It's not just a trend, it's a long-term strategic reallocation of capital. But it's not only Asia. Emerging markets across the globe are also getting a bigger piece of the pie. Think about Latin America, Africa, and Eastern Europe. For decades, these regions were considered high-risk, peripheral plays. Now, they are being recognized for their demographic advantages, resource wealth, and untapped growth potential. Investors are diversifying, seeking higher returns that are becoming scarcer in the developed world. This isn't just about stocks and bonds. It's about direct investment in businesses, real estate, and new projects that will shape their futures. And then there's a timeless safe haven: gold. In times of uncertainty and currency debasement, capital historically flees to gold. We're seeing central banks around the world increasing their gold reserves at a record pace. This isn't just a move by individual investors. It's a coordinated strategy by nations to de-dollarize and hedge against geopolitical risks. Along with gold, other commodities are also in the spotlight. Resources like copper, lithium, and agricultural products are crucial for the green energy transition and for feeding a growing global population. Capital is flowing into the real, tangible things that the world needs. Another powerful player in this new game is the Sovereign Wealth Fund. These are massive state-owned investment funds, primarily from resource-rich nations in the Middle East and Asia. They are deploying trillions of dollars globally, but with a strategic twist. They are no longer passive investors in U.S. markets. They are now active, strategic players, buying stakes in key industries, forging international partnerships, and investing with a long-term, geopolitical vision. They are shaping markets, not just following them. What all of this points to is a fundamental change in market psychology. For over 70 years, the default setting for global capital was when in doubt, by the dollar, by U.S. assets. The United States was seen as the ultimate safe harbor, the undisputed center of the financial universe. That belief system is now eroding. We are entering an era of multipolar capital. This means there is no longer a single, dominant center. Instead, we have multiple hubs of financial power in New York, London, Shanghai, Dubai, and Singapore, all competing and cooperating. It's crucial to understand that this is not about the collapse of America. The U.S. economy remains a powerhouse of innovation and consumption. The dollar is still the primary reserve currency, for now. However, this is about a relative shift, a transfer of financial power. It's like a game where one player has been dominant for a very long time, and now other players are getting stronger, changing the dynamics of the entire game. The U.S. is moving from being the center of the system to being one of several key pillars. This transition from a unipolar financial world to a multipolar one is arguably the most important economic story of our time. It will create volatility and uncertainty, but it will also create incredible new opportunities for those who understand the shift. The industries and nations that will lead the next few decades are being determined right now by these capital flows. Ignoring this change is like trying to navigate a new landscape with an old, outdated map. So, what is the key message here? What should we take away from all this? The most important thing to remember is that capital is a leading indicator. It's the smart money that moves first, signaling future trends before they become obvious to everyone else. The movements we are witnessing today out of certain U.S. assets and into Asia, emerging markets, gold, and strategic commodities are not just noise. They are a powerful signal. They are signaling the beginning of a new global financial order. This new order will be more decentralized, more complex, and more competitive. It will challenge long-held assumptions and reward flexibility, diversification, and a truly global perspective. The era of simply betting on America and winning is giving way to a more nuanced world where winners and losers will be determined by a much wider range of factors. Understanding this shift is the first step toward navigating the challenges and seizing the opportunities of the coming decades. This isn't just about finance, it's about the future of global power. Thank you so much for watching. If you found this analysis insightful, please consider liking this video and subscribing to the channel for more content that helps you make sense of a rapidly changing world. We'd love to hear your thoughts in the comments below. Where do you see global capital heading? Thanks again, and see you in the next video.